Las Vegas, Nevada, a city that was built on risk that echoes from the casinos and bleeds into the city's housing market. It is well known that the Las Vegas real estate market is the most volatile in the country. The boom and bust cycles here cannot be matched by any other metro. For years, things had been great and everyone in Vegas was winning, but as of this spring, the situation is rapidly changing. Right now in Vegas, inventory is stacking to levels we have not seen in years, providing the fuel necessary to spark one of the biggest crashes in real estate history. This may sound like an exaggeration built up for a YouTube video, but it's a fact based on relatively recent history, and to understand it, you first have to take a step back to 2006. In my last video, we talked about Phoenix and how home prices there collapsed 56% in the '08 crash, making it one of the worst collapses on record. But Vegas suffered a crash that was even worse. In fact, without question, it was the worst drawdown that we have definitive records of in American history. From the summer of 2006 to the spring of 2012, a typical Vegas home lost 62% of its value. The stories from that era bordered on the unbelievable. In some neighborhoods, it wasn't unusual for homes to lose as much as 80% of their value, wiping out almost everyone's equity, making Vegas the #1 foreclosure market in the country. In fact, alongside Miami and Phoenix, Las Vegas was the poster child of the 2007 housing collapse. People forget how brutal it really was. If you bought a home in the summer of 2006, you wouldn't have seen its value surpass your purchase price until June of 2021. 15 years just to break even. To understand just how bad things got, we can look at another side of this city. By adjusting home prices for inflation, we get a clearer view of true value over time. You see, from 1987 to 2000, Las Vegas home prices remained flat in real terms, exactly what you'd expect in a stable market. Home prices, historically speaking, don't actually make a lot of real money. They tend to follow inflation, as seen here. But starting in the early 2000s, speculation drove prices way above historical norms. By 2006, prices reached 2 standard deviations above the long-term average, a clear red flag. When the bubble burst, real prices collapsed to their lowest levels on record, falling far below what was considered normal, and as you can see over time, the bubble reemerged. There is no doubt that on a real basis, the '06 market was worse, but this market today comes in a close second. Nothing about these prices is normal, and over time, the tendency to revert to the mean will always override the potential for more gains. In 2022, it looked like Vegas was going down this path again, only to be saved by a resurgent market. This time around, however, that last gasp for air is running out. You are already seeing the stock market give out, and with each earnings release, tariffs tightening, and unemployment jumping up, the scaffolding holding this entire bubble up will begin to give way, and what happens is this: a complete collapse, first slowly, then all at once. This is especially true here. The Vegas market is unique in the sense that it's very prone to these large fluctuations, and when they get going, it's very hard to stop the momentum. It's a real estate market that relies so much on Californians moving in and paying premiums, and it's obviously relied on the local gambling and tourism industry, which we will get to in a second. But before we get to that, let's talk about the present. I just gave you the historical overview of Vegas, showing the potential of future crashes, but you might be saying, well, what about now? Prices are clearly not crashing here if you look at Zillow, for example. According to Zillow, over the past year, a typical Vegas home has actually gone up in value by 4.1%. So why am I concerned or even making this video? Clearly the price drops are just not there, but something else is happening that points to a rapidly changing future. Vegas has already shown that it's susceptible to rapid, quick falls in value. In 2022, we saw this happen overnight, and it coincided with the fall of the stock market and the casinos. Specifically, if you look at Vegas overall, it's mostly influenced by Californians moving there and paying a premium. Over 48% of the migration happening to Vegas is Californians. In 2022, there was an 8% decline in this specific migration pattern, and in 2023, a 14% decline. Now, if you look at the chart, it's pretty clear that this mini crash happened when the big money stopped coming. And while we don't have real-time stats on net migration, we do have this: inventory. Just like in 2022, inventory here is exploding, and this time from a higher base. From February of last year till now, Vegas has added about 6% more homes each month. This means now in the spring selling season, when inventory rises the most heading into the winter, at this current pace, it would take less than 6 months for the inventory levels to surpass the 2022 high. And if that happens, we are going to see massive drop-offs in this bubbly market. So while prices right now seem fine looking at a chart, there is just no way this can continue with this buildup happening. Inventory is almost always forward-looking, meaning you can get a great glimpse into the future by simply looking at sales and supply data, which is what this is. Now, when you factor in a falling stock market, rising unemployment, and the reality that Vegas trips are among the first luxuries people cut during a recession, it becomes clear why this could be shaping up like another 2008. Vegas is the perfect spot for things to completely give out in the next recession because the market is so sensitive to the big California money, and when they stop moving here, prices just completely freefall. Inventory is a reflection of this, and overall throughout the country, we're seeing this massive shift. Just take a listen to this interview by Compass CEO Robert Revkin. Read between the lines. What he's saying is that things are rapidly changing in the market, and while he's framing it as a good thing, keeping things balanced, keep in mind that Vegas has a lot of room to fall.
Why is new construction cheaper than existing?
Inventory. We now have 30% more inventory this time now than this time last year. And with more inventory, there's more options for buyers, but also less upward pressure on prices.
Remember all those times you'd come on and we'd be like, please, just a little inventory is all we ask. We finally got it.
Yep.
Yeah?
We finally got it. And by the end of this year, we should be in a place where we have as much inventory as in 2019, the pre-pandemic period. So yes, the era of there just not being enough inventory is over.
What about prices overall?
So prices overall, they're defined by the actual price, which is flat overall. But the price drops right now. 36% of homes on the market have a price drop. That's more than any April in the last 12 years. And again, it reflects that when there's more inventory, that buyers have more negotiability relative to sellers.
So as you just heard, this is happening throughout the country, and Vegas is no exception. If you look at the variables at play here, things are building up for a situation similar to what happened 20 years ago. We have bubbly real prices adjusted for inflation, a falling stock market, talks of recession, falling gaming revenues, and massive jumps in inventory. Now, if you look at California, you're starting to see the tide turn over there as well. New mayors spending more time fixing the issues that caused so many to move away from there, and now when you combine this with a potential recession, you start to see why the next situation could be just as bad as '06. Thank you guys for watching. As always, please make sure you hit that like and subscribe button if you enjoyed it, and let me know what you're seeing if you're a buyer or seller in the Vegas market today.